Welcome to The Explainer. Today, we're cracking open a fascinating dossier on wealth accumulation to really decode the whole story of investment. Whether you're just starting out or you're looking to sharpen your current strategy, we're going to explore the mechanics of growing your capital together. We're going to strip away all the noise and look directly at how to actually achieve financial freedom.
Here is our roadmap for today. We're going to cover the wealth creation engine, essential asset classes, core investment concepts, the investor's bookshelf, and then we'll wrap up with a beginner's roadmap. Let's dive right in.
All right, Section 1, the Wealth Creation Engine.
So, I've got a question that might make you a little uncomfortable right off the bat. Is your money actually shrinking? I know, it feels incredibly safe seeing a fixed number sitting quietly in your bank account, right? But historically speaking, cash just hidden under a mattress loses nearly half of its value every single decade. So if your money is just sitting still, it's literally silently losing its value.
Just look at the invisible math here. It's actively destroying your purchasing power. If inflation is running at, let's say, 5% annually, but your traditional savings account is only giving you a 1% return, your real-world buying power is shrinking every single year. Basically, what you can buy today is going to cost you more tomorrow. Investing isn't just a strategy to get rich, it is absolutely mandatory just to beat inflation and keep your head above water. Looking at the Masterclass dossier, it defines investing beautifully. The golden rule is pretty simple. Money you delay spending today absolutely must return greater purchasing power tomorrow. To pull this off, we don't just gamble, we take calculated risks. We're looking to acquire assets that either produce a steady cash flow or actually grow in market value over time.
Okay, moving on to Section 2, essential asset classes.
To build a truly resilient portfolio, you've got to know your tools. First up, equities, or stocks. When you buy a stock, you literally own a fractional piece of a real corporation like Apple or Microsoft. Now, they do carry higher volatility, but they also offer some of the absolute highest long-term returns. Plus, you often get recurring dividends. Then we have fixed income. Think bonds and treasury bills. These are basically loans you make to a government or a company in exchange for a steady, predictable income. They're generally a lot safer than stocks. Next up is real estate, which gives you rental yields and acts as this massive, tangible hedge against inflation. And finally, commodities, like gold. Historically, gold acts as a safe haven, preserving your purchasing power when the economy takes a hit.
Now, on the total opposite end of that safety spectrum, the dossier highlights digital and alternative assets. We're talking about things like emerging cryptocurrencies and private equity in early-stage startups. These have a much higher risk, higher reward profile. They can be incredibly volatile. So you really need a rock-solid understanding of the technology and a genuine appetite for risk if you're going to explore the space. But let's be real, for most of us, trying to pick the perfect individual stock or perfectly time the next massive crypto wave is incredibly difficult. That's why the absolute key is leveraging index funds and exchange-traded funds, or ETFs. Instead of gambling on one single company, an index fund like the S&P 500 lets you buy a basket of hundreds of top companies all at once. This gives you instant diversification, ultra-low fees, and really reliable market average growth. It's honestly a total powerhouse tool for the everyday investor trying to secure their future.
Which brings us to Section 3, Core Investment Concepts.
This quote from Albert Einstein is arguably the single most important concept in all of finance. Compound interest is the absolute core engine that powers long-term financial independence. It's basically this magical process where your returns start generating their own returns. The longer you leave your money to grow, the more explosive the math becomes. Like Einstein said, you either understand it and earn it, or you ignore it and spend your life paying it to others.
And you know what the absolute best way to fuel that compounding engine is? Dollar cost averaging, or DCA. This just means investing a fixed amount of money at regular intervals, let's say $100 every single month, regardless of whether the market is booming or if the news is screaming that the sky is falling. The absolute beauty of DCA is that it takes all the emotion out of trading. It naturally forces you to buy more shares when prices are cheap and fewer when they're expensive, which naturally lowers your average costs over time. Beyond DCA, we really have to respect a couple of unbreakable rules here. First up, risk versus return. There is absolutely no such thing as guaranteed high returns without taking on higher potential risks. If someone promises you a massive return with zero risk, run the other way. Second, diversification. Never ever put all your eggs in one basket. Spreading your capital out across stocks, real estate, and bonds is exactly what protects your overall portfolio if one specific sector takes a massive hit.
All right, let's look at Section 4, the investor's bookshelf.
Listen, if you only read one book from this entire explainer, Make it this one, The Intelligent Investor by Benjamin Graham. Warren Buffett himself famously recommends this as the best book ever written on investing. It is literally the absolute Bible of value investing. More than just crunching numbers, it teaches you emotional control, how to minimize your risk, and how to figure out a company's true value while completely tuning out the daily panic and noise of the market.
The rest of this essential reading list builds so beautifully on that foundation. Morgan Housel's The Psychology of Money shows exactly how our own egos and human behavior totally mess with our math. Then you've got Robert Kiyosaki's Rich Dad, Poor Dad, which will shift your entire mindset on what an asset actually is. Add in Burton Malkiel's Hard Proof in a Random Walk Down Wall Street on why index funds mathematically beat individual stock picking, and Peter Lynch's One Up on Wall Street Guide to Spotting Everyday Winners, and you've got yourself a bulletproof foundation.
Finally, let's wrap up with Section 5, the Beginner's Roadmap. Let's turn all this theory into actionable steps for your own wealth journey. According to the dossier, you really want to tackle these sequentially. Step 1. Build a secure emergency fund covering 3 to 6 months of living expenses before you start heavily investing. Step 2. Crush that high-interest debt, like credit cards. The massive interest rates on consumer debt will actively destroy any gains you make in the market. Step 3. Start small. Allocate some monthly savings into broad market index funds, like those ETFs tracking the S&P 500, just to build those crucial compounding habits. And Step 4. Continuous learning. Read the books we just went over, master market psychology, and always remember, never invest in assets you don't fully understand.
I want to leave you with a really stark choice to consider as we wrap up this explainer. Every single day you wait, inflation is acting like a silent tax, quietly draining your hard-earned purchasing power. The tools to build financial freedom are sitting right in front of you. So the ultimate question is, will you sit by and let time erode your wealth, or are you going to take action today and let time compound it?